All right, we're live. Happy Sunday. I got my favorite. What do you okay? It's loan originator. I don't like saying like loan originator.
Mortgage lender, mortgage broker, whatever you want to call it. Just
Mortgage broker. I like mortgage broker better.
yeah, me too. Happy to be here.
Yes, I know. I know a lot of people have a lot of questions regarding the portable mortgage, regarding the potential 50-year mortgage, and I really don't know. So that's why I was like, we gonna have to have Will on here. Hi, Janet. Happy Sunday. We did have a great Thanksgiving. How was your Thanksgiving? Hi, Karen. Karen says, hey, Alexis. Hi, William. You gotta put Will.
William sounds super official though.
It does sound super official.
Do you
Hi.
know my middle name?
I do not.
Oh, it's very presidential by design. William
Mary.
Simon Butler.
Okay. Simon?
Simon. So fun fact, I used to be into fashion a lot more with suits specifically, and I was gonna start a clothing line called William Simon.
That does sound really like
Right.
I kind of have like to have my pinky up, like saying that.
Yeah, you do.
Wow. I love that. Okay. Hey Pedro. Janet said it was awesome. Janet, did you cook? Hi C's Sesco Bar. Don't know who that is. Happy Thanksgiving. Yes. Hey Phil, how you feeling? I know you wasn't feeling hot last weekend. Did anybody go shopping for Black Friday? I did not. I don't even know what was on sale or any of that. How about you, Will? Did you go?
Just online shopping, nothing crazy. Didn't
What
really
did, what did you get? Did you get anything?
a lot of presents for the kids specifically.
Ah,
Yeah.
okay. Man, I didn't even honestly look.
No,
Mm-mm. Pedro said yes, but all online.
that's the
What
way
what
to do it now.
what did the kids want, Will?
Electric scooters. They're really into K-pop Demon Hunters right now. My daughter specifically.
Did you see where the K-pop Demon Hunters, the dolls, is like three in a pack and is $150?
I don't even know what you're talking about. But no, not that. I got her a bunch of like clothing and stuff like that for it.
Oh, okay.
And then she's really into How to Train Your Dragon. So we got her like the big dragons, a dragon that actually flies, remote control flying dragon from the movie.
Wow.
You
That's
know, just
cool.
the kid things. It's a
Yeah.
lot different than we were kids, that's for sure.
Yeah, and I really feel like the older the kids get, the harder it gets, right? In the sense of, and the more expensive it gets.
Mm-hmm.
Because when you have little kids, it's like you could buy them little things here and there and they're going to be extremely excited, right? But it's like the big kids is not my big boys. They're like cologne, and the cologne is at least $100, right?
Mm-hmm.
And then sneakers and all of that stuff. So it's getting more and more expensive now.
Yeah. When they start asking for MacBooks and all that stuff, yeah, I can imagine.
Oh, I felt all that. I'm so glad to hear that you feel better, Phil. Karen said no, not really online. Just bought some small stuff and household items from Sam's Club. Okay. Janet said Black Friday sales are not the same anymore. No, they're not. I remember where it was like, everybody would hurry up and eat dinner on Thanksgiving and then like go to the stores and wait on like those long big lines and hopefully not get into a fist fight with somebody, right?
Right. Those TVs, the 55-inch TVs, which are now like the cheap TVs apparently.
Right?
Oh
Oh
yeah.
my goodness. Pedro said was watching the news that online shopping has replaced the brick and mortar shopping. I believe
Mm-hmm.
that.
Yeah.
Phil said gift cards. Okay. Hey, Sally. Janet said I was one of those. You were one of those, Janet? You make sure those potatoes are cooked. Phil said 39 years of retail here. I'm doing great, Sally. Sally asks, how are you?
I'm doing great. I'm doing great. Just we talked about it before we went live here, but yeah, just happy to get back to things. Hosting Thanksgiving, family in town, all that fun stuff. Enjoyable, but
My social battery will be like
right.
that.
Yeah.
Yeah, I'm the one. I don't know if anybody's out there like me. I cannot entertain. Like I can't. Like even if like my in-laws come or anything like that, I'm downstairs for a little bit and I would just sneak out like a ninja and go upstairs. Like not even bye, see you later, good to see you, none of that. I'm going upstairs.
What do they call it? The Irish goodbye?
Yes. That's me all the way. I don't know. I'm not a big entertainer. I'll go to somebody else's house, but me, I'm not a big entertainer. All right.
Vic's an entertainer, right?
Vic can't, yeah, he's definitely an entertainer. But yeah, no, our house is too chaotic. It's the kids and I know. Oh yeah, Chas, Chas said, we are like you. Yeah, me and Chas are right there within each other. Okay, so Will, tell us what's going on because we have questions regarding this portable mortgage that I still don't really understand like that. A 50-year mortgage. So come on, educate us. We are your students.
Well, I mean, first I would say, where's this all spawning from? And it's spawning from the idea that home ownership is becoming unaffordable for the average American. So right now, what they're doing is they're exploring all of the different options to try to make affordability possible, so that the next generation can start owning properties, which I can appreciate. Now, the question is, are these solutions that are presented, these solutions that will solve that problem? I don't know. And I don't think anybody actually knows. And do I think it's the best solution? Probably not. But what I can say is that it is a solution, right? So let's start with the 50-year mortgage to start, right? If you look at the numbers on a 50-year mortgage, you're basically paying double in interest what you were paying on a 30-year mortgage. So let's just call it a $500,000 property. And on that $500,000 property, instead of paying $1 million in total for a 30-year loan, you might be paying 1.5 because it's a 50-year mortgage. And when you look at those numbers, like that seems not great. It seems pretty awful, honestly. But when you look at it from the perspective of this opens the door for more people to become homeowners, then it is a solution. Because if a home that you're looking at, let's say your budget is, $2,500 a month, but you find a property that meets all of the needs for your family, but now it's, for that same property is costing $2,800. Now you can get that property within your budget, and now it's yours. It's something that you own, that you develop equity and appreciation with that property, and it gets you in the door and helps you become a homeowner. So I think it is a solution that's going to be helpful to make affordability more possible for more and more people. And if you already own a home right now, I think those are going to be even the bigger winners, right? And the reason I say that is, let's say you're with where you live right now, the average price point, or even in Central Florida, is what, like $350, $400, something like that. So let's just call it $400,000. If 20% of homeowners or home buyers rather can now buy a home because they have more flexibility in their purchase power, let's just say 80% of them or 50% of that 20% can now buy. That means there's going to be more of a demand for homes, which means if you already own a home, you're in the path of appreciation. So the values of your home are going to increase because now there's a lot more buyers entering the buying pool, which will spike demand and raise the value of the property that you have. So I say, like, for the 50-year, I don't think it's the best solution, but I think it is a solution. And it's one of those things where, when you weigh your options, it is a tool in your tool belt that will be able to solve some problems and help people become homeowners who really, really desire to make that happen.
So Karen, hold on. Phil said, well, could you use the 50-year mortgage to get your foot in and then refinance later to a smaller mortgage if that's within your financial budget?
Oh yeah, 100%. I mean, right now, like, the average mortgage is how long? Does anybody know? Any of the guests want to chime in there?
Does anybody know what the average mortgage is?
Like timeline wise.
Hold on, let's give them a few seconds.
Or even if you own a home, what is the length of your mortgage?
Janice says 30 years.
30 years. Perfect. So would you believe that there was a time where 30-year mortgages were scoffed at?
Really?
30 years, that's ridiculous. Who's going to mortgage something out for 30 years? That's too long of a risk. There's no way. It doesn't make any sense. But now a 30-year mortgage is the norm. A 10-year mortgage is already on the table, 15-year mortgage on the table, 20-year mortgage, 25-year mortgage. Those are all always on the table. Like in my career, I've done close to 800 closings in my career, and I could probably count on two hands, because it's more than 5, less than 10, who've done a 15-year mortgage or anything outside of a 30. So that's how like everyone's defaulting to that. If you're a cash flow investor, you're picking up properties, you're extending that mortgage because that means more money in your pocket every single month. And then when you also do the math and you look at it, like a 15-year mortgage, the rate will always be better on a shorter term mortgage than a longer term mortgage, right? So let's just say you're at a 6% on a 30-year, but you're on a 5.5% on a 15-year. Like that might make sense. You'll be able to save on interest, and you're paying it off a lot quicker, so that you don't, have this debt that's kind of lingering for the majority of your life or a long period of your life on a 30-year, right? But if you just take the extra principal that you would be paying on a 15-year mortgage, you look at the numbers on a 15-year mortgage, and I just say, hey, I'm just going to pay an extra $500 a month on the same 30-year mortgage. You'll still probably chop it down in the same time period, but at the same time, not be committed to a payment that might be 2 times more than a 30-year mortgage. Does that make sense?
Mm-hmm. Mm-hmm.
So I think that's why most people do it. And so if a 50-year rolls out, it'll be the same.
Karen said, what if you do a 50-year mortgage and then pay extra each month in the principal payments only? Say if it's a mortgage of $1,700 a month, all inclusive, then make an additional $1,700 in principal payments.
Then you'll knock that thing out much, much quicker. That was literally the same exact example I just said on the 30-year mortgage.
Hi, Cosette. Yeah. No, that makes sense. So everybody was answering your question. Pedro said at 50 years, a person will never see the end. So that's the kind of but I could also see it in the perspective that you provided, where back, there was a time where people were like 30 years, like you would never see the end at 30 years. So I think I like where you also said where it's a tool, right? Like you may not need it, but it may be. Is it available or is not?
50-year?
Yeah.
50 years not available. We don't even know if it's like concrete happening, yes or no yet. It still has to be passed and approved. And one of the hurdles that they're running into with it specifically is mortgage insurance. Like private mortgage insurance, or PMI. They're like, we don't want to insure something for 50 years either. And which also kind of leads me into the second question you had, which was portable mortgages.
I have you're going to have to school me right now.
All right. So the simplest way I could describe a portable mortgage is, think of your mortgage like a backpack. All right. So let's say I bought a house at $400,000. Let's just say my loan amount is $400,000 for conversation's sake. And my interest rate when I bought my home was 4%. All right. So $400,000 loan, 4% interest rate. And let's say the way a portable mortgage work is, let's say 20 years later, I want to buy this new house. And this new house is $1 million. And what I owe on my $400,000 mortgage is now $200,000. So the way a portable mortgage would work is, I would take that $200,000 that's left on that original mortgage, my backpack, my $200,000 backpack, and then I'd move it over into the next property. So I would only have to finance the difference between the purchase price, which would be $1 million in that scenario, and $200,000. So the difference I would have to finance would be $800,000. So the portable mortgage is that original $400,000, which is now $200,000 because you paid it down over X amount of years, carries over to the next property, and then you only need to finance the difference between the two.
But they're going to have different interest rates.
Exactly.
Okay.
And I think this would be harder to pass than a 50-year mortgage.
Why?
Well, because in America, it's all about risk, right? They're examining risk and they're looking at it. I mean, when you are looking to buy a property and you're financing, let's say all the numbers look good in terms of what a client makes and they can easily afford a property. But you have an inspection and then you have something else that could also throw a wrench in a deal. What's the second piece?
The appraisal.
The appraisal. When a mortgage lender is evaluating risk on a property, they always want to make sure that their equity position or the collateral, which is the home, is always secured. When you're moving it into another property, that portable mortgage doesn't have any say on that next property. So the private banks and things of that nature, like, what are they going to do? Secondly, to make that, pass and make that work, all the banks would have to agree they're willing to do that. And that means less money for them. Because right now, for you to buy another house, you got to get a new loan, and they want you to buy it with the 6% rate of today as opposed to the 2% rate of 2020.
It feels like there would be a lot more steps too, because there's just so much. There's just so many different moving pieces.
Oh, yeah, 100%. That's why I think that's going to be even harder to pass than a 50-year. But if they both happened, I would be happy. I don't know if they will or not, though. But
yeah, I mean, yeah, because again, it's another tool for someone who may need it, who, that's kind of like where people have been renting for 30, 40 years, right? And it's kind of like where they don't even see the fruits of their labor because they just paid off their landlord's home, right?
Mm-hmm.
So I definitely can see how it may be beneficial to someone. Hold on. Let me see. Okay. So Cosette said, Will, did you bring cupcakes today? She loved your wife's cupcakes.
Did I bring it today? To what?
She's being funny.
Oh, gotcha. No, I didn't. But,
We'll bring you some cupcakes, Cosette.
Yeah. Let me know next time you're in Orlando.
Raymond said, we're at the end of a multi-generational Ponzi scheme where the goalpost was constantly moved back.
It's an interesting take.
He's also said, will they even write one to anyone over 35? I smell lots of age discrimination with 50-year mortgages. That's actually a good question. Like, how do you, let's say there's someone who wants to, who's 60 years old and wants a 50-year mortgage, right? Are they?
No, they're not going to discriminate against you. Right now, you already can't discriminate against somebody based on age. It's illegal.
Yeah. So it's part of the, what is it called?
It's RESPA, TILA.
There you go.
There's so many different regulations that prevent that from happening. Yeah.
Phil said, Will, what kind of opinion would a 21-year-old, you mean option? What kind of opinion would a 21-year-old would have 400,000 or less?
I'm not sure I understand.
Phil. Chastity said, Scott said, can you take equity out of your current house to put it on your new house and pay it back when it's sold?
Yes.
Will said yes.
Yep. I mean, I'm doing one like that right now. They took out a HELOC on their current primary residence, and they're buying the house literally 2 homes over.
Two homes over?
But it's bigger. It's like it's the big house on the block, and they've always loved it. So yeah, they took out a HELOC on their primary residence, and then are going to rent out that property that they're currently living in, and then they're actually closing this Friday on the big house on the block. So,
oh wow,
yeah, 2 homes over.
That's pretty cool. I mean, I wouldn't mind a portable mortgage because I have a 1.99 interest rate on my house now. We owe about I think it was like 265, right? And it goes for about 480.
Mm-hmm.
What? No. Definitely about 480 because the one down the block in the new community, they're not. Okay, Okay, babe. I'm the one who does this like day in and day out, and he tries to school me, but that's not happening. Okay, Phil said option. Okay, what kind of option would a 21-year-old have $400,000 or less? Do you mean house-wise? I'm not understanding. So, Will, what's going on in besides these two really big topics right now in the mortgage world? Where are rates? What any new programs? Tell us what's going on.
Yeah, well, I mean, we already currently have a 40-year mortgage, which I'm pretty excited about because apparently I've always had access to this 40-year mortgage. It's just never really been a talking point because it does require more of a down payment than a traditional loan, right? So, but yeah, if you have 10% down, you can actually do a 40-year mortgage today already.
10% down.
Mm-hmm.
So so then if we're doing a 4, does it have to be conventional?
It is a non-qualifying mortgage product, so it's neither. But yeah, it's basically the income will be qualified the same as a conventional would, for example. It just requires 10% down. And then the cool thing about non-QM loans or non-qualifying mortgages is that there's no PMI. So if you bought a home, FHA, conventional, anything like that, and you put less than 20% down, you will be required to pay PMI or private mortgage insurance, which is why a lot of people think you need 20% down to buy a house. Whereas if you were to do a non-QM loan like this one, 10% down, and there's no PMI, and PMI on like a $400,000 house, depending on what your credit score is, can be literally like $150 to $400. It just depends on what your credit score is. So it's a big savings if you have good credit, and and you can make it work with a non-qualifying mortgage product.
So what would you say is good credit as far as that is concerned? What would be the minimum? I know that there's a lot of different factors, right? But
yeah,
just give or take.
Yeah, I mean 680 on non-QM typically is what they're looking for. You can do 640, but you're going to get punished in terms of your interest rate, things of that nature. Mm-hmm. So I just pulled up the rates for today, and yeah, I mean the rates. I'm sorry.
What website do you use?
I use mortgagenewsdaily.com.
I'm going to put that in here so you guys can take a look too. Mortgagenewsdaily.com. That's to look at the interest rates. Okay, so what did they say?
So Mortgage News Daily, and let me provide some context so everybody's kind of aware. Mortgage News Daily is a third-party website in the mortgage world, and basically what it does, it tracks the prime rates of mortgages. So when you go up here and you pull up the page, let's say you're doing it on your phone or you're doing it on a browser, you'll see a bunch of posts. They post pretty much every single day updating you on news that's happening in the mortgage world. But if you scroll down just a little bit, you'll see the mortgage rates. So the very first rate that you'll see a 30-year fixed. The prime rate on a 30-year fixed mortgage today is a 6.22. A 15-year is a 5.78. And then FHA 30 years a 5.86, and then VA is a 5.88.
So we're in the fives
on government loans, yes.
Mm-hmm.
Which is nice.
That's very nice. I don't know if you know this, but there are bigger builders now that are offering lower interest rates on to-be-built homes, because it was where they couldn't how do you say, they couldn't offer a low interest rate, like as if a move-in ready where you could do 3.99, 4.99, whatever. Mm-hmm. But now there's some builders who are offering a lower interest rate on to be built, as long as it closes within a certain time frame, because you can't go too far out.
Right.
So from what I've seen is like April right now.
Yeah, I mean that makes sense. Because basically the way that the mortgage world works is the longer you do a rate lock, the worse the pricing gets. So, if you do a 30-year lock, a 30-day rate lock, which is, most contracts are 30 days, you'll typically just do a 30-day rate lock, be good to go, and keep it moving. But if you're doing a new build, like, as a matter of fact, we just did a new build where the builder took a little bit longer to close on the deal, right? And,
you and I?
Yes.
Oh yeah.
And sometimes builders are a little bit delayed. Like in that scenario, the builder themselves would be punished as long as they're not passing that cost to the buyer for being late on their contractual deadlines. Then it's a win for the consumer, assuming that rates, didn't go down. But I mean, we're expecting 3 to 4 rate drops next year. So
3 to 4.
3 to 4. Yep. Which would be really, really nice and would take a lot of pressure off the market and first-time home buyers and things of that nature.
Oh yeah, absolutely. Okay, so then so when you go, let's say you go on, you have a 30-day contract, okay?
Mm-hmm.
Are you locking in the interest rate at all?
Yeah, well, that's what, typically when, let's say I receive a contract today, market's not open today, so we wouldn't lock today. What we would do is we'd have the conversation when the market opens tomorrow morning with the client and then give them the option. Hey, here's what the rates are. Here's what the payment looks like. Is this something that makes sense for you? We can lock or we can float. And my advice right now, just because there's a lot of uncertainty, and it's funny because I did this the other day. Side note, I did this the other day. I was talking to my kids about doing something and I went like this and they're like, why are you doing 6-7?
6-7. Oh my gosh.
It's like I was weighing your options. I wasn't saying 6-7. But yeah, it's just funny. When I started doing this, I was like, now it's ingrained into my head.
Right? The stuff these kids come up with now.
Crazy. But you give them an option like, hey, you can lock at a 6 or maybe 7 in 30 days if you choose not to lock now, but you give them the option and then they decide. But most people are, in this market right now are just they're locking. Sometimes they float if they're a little bit riskier. But if the numbers look good, then I always suggest just locking if you're comfortable with the numbers, because there's no guarantee rates ever drop, no matter what the market will even tell you. Like that link, Mortgage News Daily, you go there, it'll give you a bunch of updates on what you can expect and things of that nature. Like rates were supposed to be 4% this year,
Yeah. Oh yeah.
Yeah.
No, I definitely, okay. So you lock the interest rate. Now let's say you lock it in at 6%, right? But a week before the rates drop down to I don't know, 5.8, right? Are you able to get the lower interest rate or no, because you're already locked in?
Yeah, once you lock, you're locked in through whatever that date is.
Okay, so there's no such thing as kind of like I forgot what it's called, the float down.
Float down, yeah, but only like a handful of lenders offer it, and then you have to kind of pay in advance for the. Basically, you're already kind of. What's the word I'm looking for? I don't want to say it's a facade, but it's one of those things where you're already building into the price. So let's just say you're at a 6, you might be selling a 6.1 that you're paying in advance for that same deal, just so you have the option to float down the road.
Down.
So you're kind of hedging your bets, but you're charging them more in advance. So it's not always a great option.
A great option. Okay. Bree said, if relocating, how long do you have? What do you mean by that? Cosette said, is it true, heard this on the news, that if I have a low interest mortgage rate, I can sell and take my loan with me to the new property I will be buying? So that's what we were talking about, which is the portable mortgage. So it hasn't got passed or anything like that, but that's exactly, that's what we were, you probably missed it, but we were talking about that, but it hasn't, like, there's no product that offers that right now, right? Like it's just something that they're trying to pass, but it's not concrete, right? They're not offering that at this point. Hold on, let me make sure. Okay, so Phil, okay, what kind of option would a 21-year-old have for $400,000 or less? So it kind of sounds like a house question versus a lender question, if I'm understanding this correctly, because Phil said, what kind of option would a 21-year-old have $400,000 or less? You mean, I'm not, if that's house-wise, I answer that. If it's mortgage, then will, but it's not written in a mortgage type of question. Okay, hold on. Okay. Karen said my current interest rate is so low, I'll probably never ever get to see that again. Would be great to move it over for my forever home built from the ground up. I know, like especially for the people who have purchased in COVID years. Mm-hmm. Sorry. I'm like starting. That needs sauce. I'll make it now. Yeah. Yeah, wait, babe. I'm on live right now, and you're trying to feed me right now to taste test.
They know I'm cooking.
Yeah, but this needs to go in there.
Okay.
But not all of it.
Okay.
You have to like drain it, but don't use all of that.
Oh.
I'm making potato salad, and my aunt makes it with like pepper and onions and a little bit of vinegar, and it tastes really good. Okay, hold on. Yes, you can. Okay, hold on. Yeah, Karen, I agree with you. I have a 1.99 interest rate, but honestly, I won't let a 1.99 interest rate keep me in a house that I've overgrown already, right? Like it's time to evolve. So, but I will use this as an investment property. Okay. Sesco said, "Can I buy my second house with my daughter's cosign, but she's going to be 18. She will be in college."
Yep.
You can, yeah. But of course she has to be working and she has to have a qualifying credit score as well. Would you say, right, Will?
Yeah. I mean, you'll be fine with that. I mean, you can even go no credit score is an option too. No credit's better than bad credit.
So Will, on like those government loans, like a QM and all a non-QM and all of that, can you have a cosigner on those?
Yeah, absolutely. It's basically a non-QM loan is basically just a loan that's not being sold to Fannie Mae or Freddie Mac at the end of the day, because those are kind of like the big government entities who kind of like insure the loans and then they buy back the loans and sell them in secondary markets, all that good stuff, which is basically bank jargon. But a non-qualifying mortgage basically means it's something that is not insured essentially by the government in terms of the mortgage. It doesn't fall into the guidelines of what a traditional mortgage would be. Which is, certain debt to income limits. You have to have, like, here's a perfect example. So if you're self-employed and you're watching this right now, one of the big challenges that people who are self-employed have when they go to buy a house is they write off a lot of expenses on their tax returns, as you should, right? If I make $100,000 with my business, but I have expenses, I have employees, I have payroll, I have marketing, I have all of these different things that I have to pay for, I should write that off. The only time it comes back to haunt you is when you're buying a house. That's it. Outside of that, you're typically not running into an issue. Maybe if you're getting a business loan, then it can come back and become a problem. But the only time that it can come back to haunt you by writing off a lot of your expenses is when you're buying a house. And here's why. If you're looking to buy a house, and let's say your business makes $100,000 a year, but I want to keep my tax liability down. If I make $100,000 a year, my taxes typically would be, let's just call it 30%, $30,000 that I now have to pay the IRS just for running my business. However, if I have marketing expenses, I have a car, I run my business from my home, I can write all of that off on my tax paperwork. So my qualifying income would be whatever, it would be my gross income minus all of my expenses, and then it would be my adjusted gross income, also known as AGI. Okay, adjusted gross income, which is gross income minus all of your expenses. That's what your income is for a mortgage. So what a lot of times what we'll see on our side on the mortgage world is, you have people who, their business does really well. They might make $250,000 a year, $500,000 a year, what have you, but after expenses, they claim $40,000, $50,000. And when they claim $40,000, $50,000, that's the only income that they could actually use to purchase a home. And so a non-QM mortgage is something that, kind of came into effect to be able to help people when they don't have all of the paperwork that the government essentially would want, right? So instead of having to pay the IRS $30,000, $40,000, instead you can just do a bank statement loan. Now, a bank statement loan, what that does, it'll take all of your deposits that you're showing on your bank statements for your business, for example, and then it'll use the actual deposits for your income, which makes perfect sense when you think of it. And that's what non-QM mortgages are for, just kind of creative financing routes to be able to help you buy homes. Now, the downsides of a non-QM loan, because you're probably thinking, what are those? The downsides of a non-QM mortgage are typically you have to have a larger down payment. So typically it's a minimum 10% down. Like a bank statement loan is a minimum 10% down. And then typically closing costs on that are also going to be a little bit more expensive. So when you're looking at if going the conventional route, your closing costs might be 3%, 3 to 4%. On a non-QM loan, you might be closer to 5 to 6%.
And are the interest rates higher as well?
In some cases, lately they have not been. I mean, the rates have been real strong on bank statement on non-QM loans in general. Like DSCR loans right now. For the audience who doesn't know what a DSCR loan is, it's a debt service coverage ratio loan. And basically what it means is you're not going to use your personal income to qualify for the mortgage. And instead, the mortgage will be based on the projected rental income relative to what the payment on the house is. So let's just say I'm buying a house and the mortgage is $1,000. A DSCR loan would just want to make sure that the rent would be at least $1,000 or $1,001. And if that math checks out, you can finance the home. And that product has lower interest rates, depending on the lender. With us, lower interest rates on a DSCR product than buying a home with a conventional loan with conventional investment loan. Lower interest rates, which is crazy.
But if you do a DSCR loan, does it have to be an investment property?
DSCR is strictly investment property.
Okay.
Yep.
Okay. Okay. Hold on. Phil said, lender. 5 would have 400. Hold on. $400,000. Are you asking what a type of mortgage would someone have if they bought a $400,000 house, Phil? I'm sorry, I'm trying to understand.
I mean, I could answer the question on the mortgage side. If
I don't know if that's the question though.
Yeah, well, I mean, I'll answer it just in case. I mean, he's asked the question a couple times, right? So yeah, I mean, basically a $400,000 loan depends on what your scenario is, but you can buy the home with 3 to 3.5% down is what you're looking at. So on a $400,000 house, 3% would be 12 grand as a down payment. 3.5 on 400,000. Oh, goodness. Let me do some math real quick. I think it's 14,000 if I'm not mistaken. It is 14,000.
Yeah, 14,000.
Yeah. So that would be your down payment. And then the way that a mortgage typically works is what a lender is essentially looking for is 50% debt to income. And debt to income, the way that works is what is your gross income before taxes, before deductions, before anything. And then everything on your credit report, including the house that you're wanting to buy, the mortgage payment would have to be 50% of that number. So if I made $10,000 a month, for example, then the mortgage payment plus everything on my credit report would have to be below $5,000 for me to qualify for that home, to buy a home with a conventional mortgage.
And the payments are going to vary on, how much you're putting down, what the interest rates are. So I just had clients they're thinking about new construction, and we had like a breakdown. So on a $350,000 house, right? FHA 3.5% down. But this is in a community with a CDD about $120 per month, which isn't horrible. Interest rate was at a I want to say it was like a 5.675. And their estimated payment was around $2,700, and that's at like a 600. That's like a 675 credit score. And again, that was just an estimate, but you know, it's going to depend on the taxes too. It's going to depend on, you know, if it's a brand new home, the homeowner's insurance, right? There's just so many different variables as far as monthly payment is concerned. Will, what have you been seeing as far as like what do you think as far as like, let's say if somebody is like, okay, I really want to stay between a $2,400 to $2,500 mortgage payment?
Like what they should be looking at in terms of like price point.
And I know there's so many different variables.
It varies so much, but I mean, probably 300 in that range. Yeah, I would stay around 280 to 320, and then there's going to be a variance. Again, taxes is going to be one of the bigger things that impact it, like in the age of the home. So the older the home is, the more insurance will be. And then, you know, taxes in Winter Park, for example, are going to be incredibly high as opposed to taxes in
Ocala
or Ocala. Exactly.
So that's so crazy, right? Because my mortgage is 1990, right? And 1997? 57, 1957. Oh, it dropped. Oh, okay. All right.
Win's a win.
Right? 1957. And I bought my house at 306. We put 3.5% down, right? But it's that interest rate that has our mortgage payment so much lower, right? Because that's crazy where a $306,000 house, you're looking now at $2,500 a month. And if you have a CDD or not, right? So sometimes, you know, and I feel, do you feel where a 50-year mortgage, do you think that will also open up or increase opportunity for a purchase price as well?
Yeah. Oh, 100%. Basically in the opening segment, that was one of the biggest reasons I think owning, like if you own a home right now and a 50-year mortgage rolls out, your home's going to appreciate, because now there's going to be so many more buyers entering the buying pool, which will spike demand. And it's just a game of supply and demand.
That's where you know, Phil even made the example where, you know, once, because you said maybe possibly 3 to 4 decreases in the rate next year, right? And he says then that means that the prices of the house are going to increase, right? Which that's what typically happens, right? You don't necessarily see a low interest rate and then prices of the house are decreasing as well, because if you have a low interest rate, there's going to be a lot more buyers on the market. So that's going to cause, you know, sometimes multiple offer situations, and there's still where very rare, but it still happens, multiple offer situations.
Right.
I always say it depends on the house and it depends on the location, right?
Yeah.
So okay.
And the agent.
And the agent, yes. Okay, hold on. Let's see. Hi, Alan. What do I? All right, Karen said mine is 3.25 2021, but it will be worth it just to get in my forever home with my daughter. The house will then become hers in the future, setting her up for generational wealth. I love that. Chastity says, so the hubby, his mom, and I have great credit, but I show low income based on my write-offs because she's owns her own business. So we are doing it based on my mother-in-law and my husband's income. Can I still be on the mortgage?
Yeah, of course. As long as like you qualify with the income on there. You know, if you're showing substantial losses and it drives the income down, then you probably don't want to be on there. But in that situation, and most times what you'll do is, you know, you'll just be on the deed. You'll be an owner of the property without being on the mortgage. And if I'm you, and that's an option, that's probably what I would take, quite honestly, because basically what that means is you're not liable for any of the payments or anything. Should anything ever happen, you're just an owner of the property. But if you want to like build your credit, things of that nature, then throw yourself on there because it'll be helpful.
Okay. Bree said, hello, William. I can't call you William.
It's okay. All right. You have to do it with 3 syllables, though, because it's fancy that way.
William. How? William Simon?
William Simon, yes.
Simone. Is Simone in Spanish? Simone. Okay. If relocating, how many pay stubs do you have to show to qualify for a mortgage? I usually put down 10 to 20% on a home.
It depends on the loan product, but if you're buying a home with conventional, you don't need any pay stubs, as long as you have an offer letter with no contingencies. So if the offer letter says you make X amount of dollars, it's guaranteed. You don't have to pass a back. And when I say contingencies, like no background checks, no drug tests, none of that stuff. It just says, here's your start date. Here's how much you make salary. You can buy a home without any pay stubs. If you're buying a home with like FHA or anything like that, you will need to show 30-day pay stubs.
Okay, so you would have to, okay. So if somebody was no, because if they're relocating, they still have the same job. Okay, but somebody is going to start a brand new job. They are not able to close on a home until they have those 30-day pay stubs.
If they have an offer letter, they can close.
Even with FHA?
Conventional loan. Not FHA.
Okay.
Conventional, you can close with just an offer letter with no contingencies on it. FHA, you need 30 days, no way around it.
Okay. Perfect. Alan with a Y said, what credit score do you need for a USDA loan?
I mean, typically 580. You can go down to a 500, but it's going to be hard to get an approval, but it can be done.
I don't know, because Will is my guy. So we close, well, we're hopefully closing this week with one of our clients, and they didn't have a good credit score, and he still made it happen. The best credit score, I want to say. I don't want to say the best.
I mean, it's in the 500s. So, I mean, it's definitely possible. But like whenever you're below, I would say below a 600 credit score, there becomes more red tape around getting a loan done. And so what lenders typically are looking for is a thing called compensating factors. Compensating factors are like, how much are you putting down on the home? Do you have any like recent lates on your credit report? Can you show proof that you've been making payments? Like if you don't own a home and let's just say you're renting, can you show proof that you have a housing expense that you've been making payments on with no missed payments in the last 12 months? When you do a no credit score loan, the compensating factors a lot of times are you can show alternate trade lines. And this is something that a lot of lenders don't even know. You can close a loan with no credit score. You just need to show alternate trade lines. You need to show one housing expense. So let's just say I'm renting in an apartment. I have no credit, but I need to show 12 months proof that I've been making rental payments on my apartment with no missed payments. That's one. And then I need to show 3 other alternate trade lines. You can use a phone bill showing you made 12 consecutive payments with no missed payments is what they're really looking for. And if you did miss a payment on that, just show them a different account. We've gotten away with using Netflix as a Netflix. Yes. They just want to see that you can maintain payments on an account without missing payments. So one has to be housing. If you're going no credit score, there's no way around that. One has to be housing, and then 3 other accounts showing 12 months with no missed payments. And you'll
is that a non-QM loan? You said?
Nope. I mean that you can do that conventional. You can do that FHA.
Really?
Mm-hmm.
See what I mean? That's amazing. So a lot of people, and I love that I have you on here, right? Because a lot of people disqualify themselves, right? They think that because they don't have a 700 credit score or what have you, right? That's why I always say it's super important to speak to the expert, right? So Will is the expert. Me, I know, the basics of what I should know, but when it comes to different financing products and different things like that, Will is your go-to person, because obviously I'm pretty sure a lot of people didn't even know that you can buy a house with no credit score. That's crazy. Wow. Okay. Any new programs coming out or have came out? Like we had a lot of buzz about Hometown Heroes, and then there was a lot of back and forth about that.
Mm-hmm.
Like any other like new maybe grants or down payment assistance or anything like that?
Yeah, well, I mean, so Hometown Heroes is still around. The money's moving much slower this time around than it did last year.
Because they didn't open it to everybody like they did last time.
So they made it for the heroes, which is how I think it should be anyways. That's what it was created for. So, that's available. And, if you're a hero, so if you're a first responder, a teacher, you don't have to be a teacher, just educator staff, right? Like you can be an admin, you can be custodian, you can be in the cafeteria, whatever, at a school, K through 12, you qualify for Hometown Heroes.
Really?
Yep. And that product it's an awesome product because it gives you up to $35,000 towards down payment and closing costs if you're a first-time home buyer. So it's really, really helpful if you're in that line of work to be able to get into a home. And in most cases, like the rate's going to be lower than what you'll get, on the market. In most situations, if you have an 800 credit score, you'll probably get a better rate not going Hometown Heroes. But if you don't, then you're probably getting a below market interest rate with Hometown Heroes, because it doesn't matter what your scores or anything on Hometown Heroes. You do have to have a 640, but everybody, if you're using Hometown Heroes, has the same rate no matter what. So there's no buy downs. There's none of that. It's just whatever the rate is what the rate is. But it's a great product to help people get into homes. If you're not a first responder or anything like that, or working at a school, we have a down payment assistance that I love. We call it it's the Magic 100 program.
Mm-hmm.
And the reason I love this product is you might have heard of like a 100% FHA loan, which basically means they'll finance 100% of an FHA loan.
Now, tell us about that.
Yeah. So there's programs out there that will help you with the down payment to buy a house if you go with an FHA loan. Okay. And a lot of times what that looks like is they'll give you 3.5% towards your down payment, which covers the full down payment for an FHA loan. And it's helpful because it gives you the money up front and it helps you get into the home. And that's what people call a 100% down FHA loan. So we have a 101.5 FHA loan. And so what that means is we can actually give you up to 5%, and you can use 3.5 towards the down payment and then use the other 1.5 towards some of your closing costs, which is really, really helpful because that takes a lot of pressure off. If there's a property that's, getting multiple offers, it's in high demand, and you don't want to go in and, if they have multiple offers and people are not asking for closing costs, you don't want to have to ask for more than what you need. So this product will allow you to, again, get 5% towards your down payment and closing costs. So that, typically if you have 6 to 6.5% of the purchase price, you can buy the home. So essentially with this product, you'll get the vast majority of what you need. And then, Alexis is a beast. She's a bulldog. I've seen her in negotiations. I wouldn't want to go against her. She can negotiate, it's not always guaranteed, but if she's able to negotiate closing costs into the deal, she would only need to negotiate 1.5 as opposed to 3%. And, that just increases the likelihood of getting your home accepted or your offer accepted on the home.
Wow. I personally haven't had a client who used that, so I don't really, I couldn't tell you my experience, but obviously you have, right? So I love that there's just products out there, and that's why don't count yourself out. You're not the expert. No, not to be disrespectful, but you're not the expert, all right? Like you're not gonna go to court and represent yourself and think you're gonna win, right? Just saying. What do you hold on? All right, if you guys have more questions, we have a few more minutes, so make sure you put them in there. Hold on, I want to make sure I'm getting everybody. James said, great show. Sharon said, very, very interesting. Bree said, can you use the car insurance payment as a verification of 12 months payment as the trade?
Yeah. As long as you're paying it monthly. If you pay it in full, they won't count it.
Okay. Now, can you talk to me about, because I actually just have a client, the same client who we were looking at numbers for brand new homes. When it comes to overtime, how can is overtime even considered, let's just say, in an FHA loan?
Yeah, absolutely. You have to document proof of consistency. And if it's trending down, FHA's not going to use it. So what that means is, let's just say in 2023, you made $10,000 in overtime. In 2024, you could have even made $20,000 in 2024. But on the year-to-date pay stubs in 2025, you're showing $5,000 or $6,000. Then I say, well, it's trending downward, so the likelihood of us being able to use this is very, very slim because it's going down. And then you may be able to fight to use the worst case scenario. But typically, if it's like a substantial decrease of more than 50%, they won't touch it. In terms of the overtime, you can always use the hourly, but when it comes to overtime, typically they just want to see at least 2 years of consistency on it, and then they'll average it out. So we're at the time of the year where, what is it? Oh my God, it's December tomorrow.
Tomorrow's December 1st.
That's crazy.
Right?
So we're at the time of the year right now where we're approaching year end. So you may be able to just say, you may be able to get away with it right now, depending on the bank that you're working with. But you might be able to get away with using year to date this year and average that income out, as opposed to,
But it would have to be 2024 and then 2025.
Exactly. You might be able to get away with it right now. Like I have banks that'll do that right now because we're approaching the end of the year. And where that becomes helpful is this, like, let's just say I made 5,000 in 2023, and then I made 10,000 in 2024 in overtime. And then this year I made 15,000. So the money's obviously going up, up, and up. Most lenders with FHA, they're still going to say, well, we need to show we're going to average out the income over 23 and 24. And they're going to use, 5,000 plus 10,000 for 23 and 24. And now it's 15,000 spread over 24 months, which, let's just call it $600 is what you'd be able to use in overtime. But if you're able to use the 2025 year-to-date total, and in that scenario, if you're making 15, 20 grand, now I can use the higher numbers of the two. And now I have overnight an extra $400 or $500 in qualifying income. And now I qualify for the home that I otherwise didn't.
And that's why I always say too, right? There have been so many instances where the builder's lender doesn't qualify, will deny one of my clients a loan, right? They'll say, okay, well, you don't qualify. Well, it's because they're only looking at, like, let's just say one product, right? They're trying to fit this buyer into just this box where the buyer's a circle and the box is freaking square, right? And so Will has saved a lot of deals for me where, yes, the builder's lender wasn't able to qualify them, but Will was, because Will has access to a lot of different products where he can see, okay, I'm going to fit this circle with this circle type of thing, right? Sharon said, I was looking early this year and I gave up because of CDD and HOA. So, I mean, it's going to depend on where, right? Because I was having this conversation too. It depends. CDD is not all bad, right? It just depends if it makes financial sense for you, right? So for me, I have a CDD. I think I pay like $170 a month. It ends up being, and my HOA is only $100 per year, which, let me tell you, I did get my bill. And what did I do? I showed Victor. And what did Victor do? He went ahead and paid it that same day. Because we're not going to have a repeat of him sleeping on the couch because my house is almost getting foreclosed because he didn't pay $150 HOA. If you know, you know. Okay, I just had to tell you that. I had to give you an update. But it makes sense for me, right? Because I live in a decent community. We have a decent amenities and whatever, right? So it just has to make sense. If it makes sense monthly, then that's okay. Or you can, of course, focus on monthly on communities that don't have an a CDD. A lot of new construction communities do have an HOA, at least that, right? Karen said, would they look at my pension payment amount before or after the federal tax comes out? I don't pay state or city taxes on my pension income.
No, I mean, you can use that income right away, and we can use the previous year to establish if it's taxed or not. But if you just started receiving it, we would have to use it as taxed until you filed your taxes, unless it's just not required at all and you don't have to file at all. Then you'll be good to go.
Oh, okay. And then Phil said, would more lenders be prone to lend more clients at the end of the year?
I don't think that it makes a difference.
I don't either. It's not, because it's the rules are the rules, essentially, right? It's not where it's like, okay, I really need to make this happen because it's the end of the year. Let me try to, then you're coming into mortgage fraud and all of that stuff, right? It's not where purchase prices and builders are completely different in the sense of, okay, well, I'm going to give you X amount of more incentives because we're in quarter 4, right? At the end of the fiscal year, things like that. But as far as mortgage is concerned, no.
Yeah.
Sorry, well, I answered your question because I knew what you were gonna say. You
Yeah,
don't
no,
like
it's
No.
spot on. It's spot on.
Guys, if you don't have any more questions for Will, I'm gonna let him enjoy the rest of his Sunday with his family before the week starts. Will, hold on, hold on, I'm gonna put your information in the chat. Will Butler.
Sure thing.
This is my go-to, guys. My go-to. This is my man. I tell my husband all the time, this is my man. Will, what's your phone number?
321 432 7905.
7905. Okay, and then your email
is just Will, WILL, at magicmortgage.com.
Will at Magic Mark. Yeah. No, I Sharon said he is good. You know what? I love Will because he'll educate me, right? And I'm always curious. Hey, Will, I don't understand this. Can you explain this to me, right? And he's always willing to do this. I was working with another lender a few years ago, and it was where it was like, are you questioning me? And I'm like, I'm not questioning you. I'm asking because I don't understand, right? Very aggressive. And then my clients were having a bad experience with him too. And my preferred people that I work with, my vendors, they're an extension of me, right? So it's very, very important that I work with the right people who are gonna take care of my family, right? So Alexis said, Bill said, Alexis, easy. I'm telling you, this is my guy. I love him so much. Hold on. Karen said, I appreciate your input on all of this. Thanks. James said, Will is the man, period. Bree said, thank you, Alexis and Will. Will, thank you so much. I really appreciate you taking some time out on your Sunday to speak with my YouTube fam.
Pleasure's mine. Thank you so much for having me.
Of course. I hope you have a great week.
Thank you. You too. All right. Bye.
Bye. All right. Kicked him out. All right, guys. I hope you had a great Thanksgiving. What did you guys think? Did you guys get value? That's always my main goal. Sometimes we don't have an agenda on Sundays, and then sometimes we're like, okay, it's education time, right? That's just my main goal, to provide as much value as I possibly can for you guys. Let me think. Okay. So this week's videos, tomorrow's video, guys, you do not want to miss it. Chastity, are you still on here? If you're on here, then you're going to have to comment. I took Chastity and her husband, Scott, yesterday to Beverly Hills to a builder called Palmwood Construction. And their house was amazing. That's actually going to be the video on tomorrow's, that's going to be tomorrow's video on the channel. Okay. So they are pure custom. Like if you need to make a room bigger, if you need to move a wall, whatever. And their standard features would be upgrades in the semi-custom builders. Chastity says yes, his favorite, so I cannot make this up. So make sure you guys watch that video tomorrow. Make sure you guys interact with the video, comment, like, right? It just starts pushing out my my video to other people. Okay, you guys don't want to miss it. So they build in a lot of areas in Florida, not just Beverly Hills. They build in Dade City, they build in Spring Hill, they build in Beverly Hills. They build a lot in a lot of different areas. Okay, so definitely check out the video tomorrow. I was a little bit off, so my energy was just a tad bit off. I wasn't feeling well, but it's okay. We made it happen anyway. Tuesday's video is going to be of a brand new construction community that Katrina and I did. Very, very nice house. It reminds me of Kalesa Townships, their Larkspur and their Gardenia mix. So we are super excited to show you guys that on Tuesday. So let me know what you guys think about the videos. Again, remember to, if you haven't subscribed to the channel, subscribe to the channel. Honestly, and I haven't told anybody this, but so this year we're gonna have about 50, I want to say it's 52 closed transactions for 2025. My goal is 100 next year. I haven't even told Vic this, so I'm telling you guys this first. My goal is 100, and that's between Katrina and I. So if you guys know anyone who's looking to move to this area, right? We also are selling in the Miami area and surrounding areas. We're selling more listing properties there, okay? Give them my information, right? A referral goes a long way for us. So we really, 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 really would appreciate that. So definitely, help us get to 100 closed homes next year, 2026, 100 families. We can definitely do it. I believe in all of us, and I believe in you guys to help us get there, right? What else? I am going to take a break. So I am going to take a few weeks. I'm thinking of possibly start coming back on the 28th of December. I think that's gonna be when I come back, the 28th, on live. I will still be, of course, on YouTube with our videos every week. That's not changing, but just YouTube live. I'm just gonna take a few weeks, especially during this month, spend time with the kids. So I think we come back the 28th, but then I will be gone for the next 2 weeks after that because I'm going on like a solo retreat, which I'm super excited about. So I cannot wait to tell you about that. So this is what we'll do. We'll plan to come back. We'll meet here 5:30 p.m. on the 28th of December. Okay. So I think that's perfect. We can talk about your Christmas and we can talk about it before New Year's, right? And then we'll have another 2-week break because I actually am going on a long week retreat. And then we'll come back on the 18th of January. So let's meet here on December 28th at 5:30 p.m. Eastern Standard Time. But you guys know that if you need anything from me, you guys see Malachi? Look, they're like, your baby's popping in and out of the background and so adorable. Yeah, because they nosy. Let me take off my, hold on. Let me take out my, all right, let me take off my back screen. So, yay, yes. Oh my goodness. That's 4 of them. They're so crazy. So you guys know where to reach me if you need anything. We're gonna, just enjoy the rest of the year. I love you guys so much. We'll still have the videos coming on the channel every week. Let me know if you need anything, and I will see you guys back on the 28th. Don't forget about me, guys, because we're about to take almost like 3 weeks off, right? 1, 2, 3, yeah, like 3 weeks off. Don't forget about me. You guys better be here on December 28th. Mark your calendars. December 28th at 5:30 p.m. Okay, you guys know where to reach me. Alan with a Y. I will be in Florida in March. I hope you get to show me around. We will definitely help you, Alan. And I hope I got everybody here. All right. Love you guys so much. Bye.
Just 'cause she